INSEAD campus in Abu Dhabi. So today is the last of our talks for the year. We will restart in September, but it will be a fantastic way to finish. We have, I think, a very exciting program for today. We're also very honored to have Professor Vikas that flew in from Fontainebleau, where he's based. He's a professor of entrepreneurship, which is a topic that's very central and incredibly important at INSEAD. But I will leave most of the introductions for Katia, who will be our MC for today, Katia Kachan. Katia is an INSEAD graduate, 2016. She's as a typical INSEAD person. She has dual nationality, French and Belarusian. She did Sciences Po in Paris before her MBA. She's been quite a bit engaged with the Middle East campus. She's done a series of cases in startups and corporate innovation in the MENA region, including the case that she supported, that she wrote with Vikas on a luxury closet. We're also proud to have, of course, Wiz, disappeared. We have, where's Kunal? Ah, yeah, he's getting a coffee. Right, so it's going to be a lovely conversation today about the case and about innovation and startup and VC in the Middle East. Katia also was responsible for the startup bootcamp that we run here on campus, which was a wonderful and very successful event. And she's also been involved with in the domain of retail and luxury goods. And she was the founder of the INSEAD Global Luxury Forum. So without further ado, I'll leave you in the capable hands of Katia. Thank you.
Thank you very much, Miguel. So hi everyone, it's a great pleasure to see you all here. We were supposed to be 200 people subscribed, so I believe that it's Arabic time, so people will come over slightly later. Yes, as Miguel said, I'm here to present the case study, the latest case study that we wrote with Vikas. And thank you very much, Vikas, for coming here directly from Fontainebleau. It's a great pleasure, and it was also great working with you, very fulfilling. The case study is about the luxury closet, and our great, wonderful alumnus, Kunal Kapoor, who is the CEO and the founder of TLC. So congrats, Kunal, for this great achievement that INSEAD wrote a case study about you. And we are all, as an INSEAD alumni, we are all proud of you. I will now move forward for the introduction of our agenda. Okay, so we will start with another brilliant INSEAD alumnus, Bahoshy, who is the CEO and the founder of Magnitt. Who will explain actually the MENA venture investment ecosystem, the status quo, and will give us numbers about what is happening in the entrepreneurship field and possibly some projections. Then we will move forward to the fireside chat with Kunal and Vikas about the entrepreneurial journey of Kunal, about the challenges and fulfilling journey as an entrepreneur in the Middle East. This conversation will be followed by a panel discussion with our honorable visitors, our guests. So Walid Mansour from MEVP, who is also a contributor to the case study and who is one of the protagonists. So thanks, Walid, for coming. And also Sharif El-Badawi from 500 Startups, who is a great contributor to the entrepreneurial ecosystem in the GCC. So I would kindly ask you to keep your questions to the end of the talk by the simple reason of just respecting the time limits that we have and be able to go and enjoy the drinks at Koya afterwards all together. So now the floor is to Bahoshy, who is the INSEAD alumnus and also a great entrepreneur in the region. Philip, the floor is yours.
Thank you very much. I have a mic.
Oh, okay.
Cool. So thank you very much. It's an honor being here as an alumnus. I think it's great to see that entrepreneurship is being embraced. And I'll keep it to the time slot to basically give an overview of what's happening here in the region. I started Magnitt, which is basically the most comprehensive data platform for entrepreneurship and VC here in the region about 4 years ago. And it's amazing to see the pace of growth that's been taking place, specifically in this space, and interest regionally and internationally. I brought the latest data, so we have all of the information up to 2019 May. And the questions that I kind of wanted to discuss, is it there? Or? Basically give an overview of where the ecosystem is at in terms of investments. Secondly, to kind of look at what's happening in 2019. Is there a change in dynamics here in the region from a geographical perspective? What are the industries that people are looking to invest in? And the question that everybody's been speaking about now is exits. What is happening with regards to exits here in the region? Without slides, it's going to be harder to present. Well, I'll start by saying that look, 2018 was a record year for a number of reasons. Number one, you saw more investments take place in MENA-based startups, and by MENA, Middle East and North Africa, obviously, than any previous year on record that we've been tracking. And that's significant because you're seeing more investor appetite at all levels. The second thing is, and I'll show on the slide, something that we traditionally do is strip out those investments in Souk and Kareem. Souk and Kareem, which are the big two startups that people have been talking about over many years, have somewhat skewed the picture because the size of those investments have been so large that it doesn't show a reflection of the underlying ecosystem itself. And when you actually include those, so when we look at this, 2018, record year, when you look at the black line on the number of investments, something that we started doing was tracking estimated undisclosed funding. There seems to be a habit here in the region by VCs not to disclose funding, so we've taken proxies for those as well to be as comprehensive as possible. And like I said, 2019 already has seen 153 investments. We have been inundated by requests to make announcements for those investments, and that's extremely positive. So like I said, when you strip out those Souk and Kareem investments, you're beginning to see this inflection of continued growth. And at the rate of investment that we've seen already year to date, we expect 2019 to be stronger than it was in 2018. This is extremely positive for the ecosystem. Governments across all levels, across the region, are focusing on entrepreneurship, and it's important to see the success stories for the investors, for the entrepreneurs, and the governments that are putting so much effort in this space. Another interesting thing to show the signs of maturity of the ecosystem is that you're seeing bigger and bigger deals. Here we listed the top 5 deals in 2018, and already in 2019 you're seeing these large Series B and Series C investments take place. And across the board that's taking place as we track quarter on quarter. More investments in terms of deal size are taking place at that late stage, which is another sign of maturity. But it's important to put it into context. Now, it's unfair to compare MENA, as I think Sharif criticized me once at a conference, to the US or Asia, but it still pales in significance to many of the other ecosystems. And governments are trying to push for this. But when you compare it, there's still a long way to go for the Middle East to be on the roadmap of the ecosystems for the rest of the world. The UAE maintains its dominance as the largest ecosystem with regards to number of investments and the amount of investments that are taking place. It was one of the front runners in this space, and it continues to show many efforts, not only in Dubai, which was historically the hub, but also here in Abu Dhabi. You have Hub 71 downstairs, and many initiatives to try and encourage this. Having said that, the dynamics are beginning to change. Egypt last year was the fastest growing ecosystem by number of investments, and you're beginning to see Saudi Arabia come online with many initiatives to come and compete, which creates a very interesting dynamic where you're seeing this competition at a policy level, at an ecosystem level, as well as at a founder level across the region for talent, which is very healthy for entrepreneurs. Again, at each of these different geographies, you have startup investors investing at different stages. Traditionally, in some of the later arrivals, it's at the earlier stage, but like we said in the UAE, they're at the later stage. Lebanon is a particular ecosystem given the challenges that were faced with Circular 331, that you're now only seeing later stage investments and not as much at the earlier stage. But the UAE continues to grow, and we expect this, especially with the exit of Careem, to continue to flourish. You'll see that PayPal mafia effect for Careem, where many of the people that work for Careem are now setting up startups, competing startups in the transport and logistics space, as well as other industries, and that's extremely healthy for the UAE in itself. When you look at the actual industries, that's another sign of maturity for the ecosystem. Historically here in the region, it's predominantly been in logistics, transport, and e-commerce. And many of the e-commerce companies actually act as logistics companies because effectively they allow for the point-to-point delivery at the end. Last year actually saw a small change. Fintech has come online in a big way. And in terms of number of investments, Fintech overtook all other industries for the first time in 2018, and that trend's continued into 2019. But it still pales in significance in the amount of investment as an industry in itself. And you're seeing more and more investors come into the ecosystem here in the region. Last year, we accounted for 159 different funding institutions that invested in startups here in the region. 47% of which had never previously invested in this startup space. You're seeing more family offices, you're seeing more CVCs and corporates playing in this space, and 30% of which came from outside of the region. Especially as startups become more mature and seek later stage funding, they go outside of the region to find those bigger tickets. And that's extremely healthy to show that there's international interest in the region. And here are examples of some of those international players, and they're big names. When you look at the General Electric, Rostock Ventures, you look at the Endeavors of this world and Axel Partners. So while the percentage may remain the same, the total number of investors continues to grow that becomes interested in the region. And what you're also beginning to see is that there are now finally in the region many options for investors at the different stages. You have new players coming online at the late stage, like STV. You have people playing at the later stages, like Series A and B, some like MEVP playing in both. But you're also beginning to see an array of accelerator programs and many early stage investors play at the pre-seed stage as well. And here you have a ranking of all of the investors in 2018. So you see multiple types of investors. Those in red are accelerator programs. Those in black are institutional investors or angel groups, and some going like 500 startups that play at the earlier stage in the 40 plus. MEVP, one of the most active investors with a focus at slightly later stage. But you're seeing many new investors come into this space, especially from Saudi Arabia, where you're seeing many new family offices create funds to invest in startups. And this has continued into 2019, which has seen a flurry of activity, as I mentioned earlier. But something that's become a new trend that we're beginning to see is exits. So this chart's a little bit complicated to understand, but what we charted here was the number of startups founded by year and the stage at which they are at based in the year that they were founded. And what's interesting to see is that 50% of the funded startups between 2009 and 2018 were founded between 2011 and 2015. Many of which are now coming up to Series B and Series C. So you're seeing this later stage activity moving towards exits in the region. And you've already seen in 2019, year to date, so May, that basically 12 exits accounts for 3/4 of the number of exits that took place in the full year of 2018. And we anticipate there to be more consolidation and more exits taking place as international players come and show interest in expanding to the region in the same way as you have Uber and Careem and Souk and Amazon, as well as consolidation in certain industries, specifically in e-commerce and transport and logistics. And this is extremely important for the investors. To date, many of the existing investors in this space have yet to see exits, only normal because you have a lifespan of about 6 to 8 years. And again, the reason we put this here is to say that many of these are still coming up to the point of exit and only raising later rounds of investments. But the second thing that's interesting is you're beginning to see the increased size of exit, at least at the outliers of certain companies, which is also extremely encouraging, not only for the investors, but the entrepreneurs that are entering this space, as well as the governments that are trying to push for entrepreneurship. It shows that these numbers are possible. They're not going to be as frequent, but it shows the potential of entrepreneurship here in the region. And so as Magnitt, this is something that we do, and we basically provide reports on a monthly basis, on a quarterly basis, and all of this information is available online. I've left it, so there's still a couple of minutes left, so I don't know if anybody has any specific questions that I can answer about the ecosystem.
Yeah, fantastic. We have 2 questions for Philip, so if there is anyone who thinks that her question or his question is pertinent.
Nope. I'll give you 5 minutes back.
Are you seeing any investment from this region in, like, for example, U.S. companies?
Jared, take the mic, please.
Are you seeing any like VC activity, for example, like leading a Series A round from here in like a US company that is yet to do business in the GCC?
I'll leave the investors in the room to speak about that. We don't track that specifically, but I believe that the mandates of many of the regional VC funds are to invest in local entities. Those are the VC funds. Sovereign funds and sovereign wealth funds have invested, the likes of PIF and Mubadala will look to make investments elsewhere, but the VC funds in the region, correct me if I'm wrong, Walid or Sharif, predominantly have a mandate to invest in the region.
Thank you.
Some have, so Endure Capital, for example, is a company out of Egypt, look to have a balanced portfolio and may do some investments abroad, but it's not the trend of the majority of the investment funds here in the region.
Thank you, Philip. Well, I love the reports. Normally I go to Magnitt and download. It's very good. I have a question. Do you track based on the ratio of local entrepreneurs versus foreign entrepreneurs? Like, for example, in UAE, the number are high, but compared to local versus in other countries?
No, so we brought out a founders report back in 2017. We're doing an updated version of that where we've tracked 1,400 investments and the founders of each of those. I don't have the data on my head, but you'd be surprised that countries like the difference is we did the top 200 funded startups back in 2017, and we actually found that the majority were not local. So if you talk about the UAE, for example, the nuance now is that when you track 1,400, you begin to see differences when you look at Egypt and Lebanon and Saudi. Different countries across the Gulf may have more local entrepreneurs than others, but for instance, the UAE, the majority are expatriate founders that have founded companies that have been funded. So we look at the ones that have been funded, not the mass number of entrepreneurs.
It was interesting that you highlighted the number of investors that you're tracking, but it's also good to maybe give us some insights. How many of these VCs are interested in coming here now? I'm pretty sure most of them are outside, but given the traction that we have here, how many of them are?
Well, I mean, so of the 156 that we quarterly reach out to all investors that have made investments in MENA-based startups, and that's probably about 159 from last year. And I think that number's gone up to 180 this year. 30% of them are not MENA-based investors. Having said that, I can tell you that currently the most inbound requests for data from Magnitt comes from Asia, whether that's from Singapore, Korea, or Hong Kong, or China. We're beginning to see more interest from Europe. America has not been as interested, the American-based VCs, for the time being, but that trend will continue to change as you see more success stories coming out of the region. But Asia, because of the structure of the Asian market, at least Southeast Asia, excluding China, where it's multiple jurisdictions with multiple demographics and the challenges with bureaucracy are very similar to the Middle East, and they see many opportunities investing or getting their portfolio companies to acquire companies with similar profiles. And as well, you have the luxury closet doing the opposite, where and myself looking at Asia as the opportunity to scale into, rather than necessarily focusing on Europe or the US.
Well, thank you very much, Philip.
Thank you.
Thanks a lot for your contribution. We have a small
Thank you.
INSEAD gift for you.
Great. I'll add that to my
Yes, and
swag.
you can and you can find some insight from Magnitt in the case study directly. So now I am glad to invite Vikas Aggarwal and Kunal Kapoor. Can you change the slides, please? For the fireside chat about our case study. So who knows in the room the luxury closet? Everyone. There is also the team of the luxury closet. Who knows Kunal? Perfect. So Kunal is one of our stars here in the Middle East as an entrepreneur. And in 2012, Kunal founded the luxury closet from his own apartment. I won't go into the details about the entire entrepreneurial journey. I think the purpose of this fireside chat is actually to understand what are the challenges and what are the opportunities of being an entrepreneur in the Middle East. So Vikas and Kunal, I give the floor to you. And you have the microphones, right?
Okay, great. All right, so I'm here with Kunal Kapoor, as Katia introduced, the CEO and founder of the Luxury Closet. So Luxury Closet is a leading online marketplace for secondhand luxury goods based in Dubai. So Kunal, thank you very much for joining us. Maybe just to start, as I saw from Katia's show of hands, not quite everybody is familiar with the Luxury Closet. Maybe walk us through a little bit, what does the company do and what's the product?
Sure. So Luxury Closet, as mentioned, is a marketplace to buy and sell luxury items. Now rewind back, let's say 5 years, and if you had a few items you wanted to sell, in the US you would go and fill a form that is as complicated as filing tax returns on eBay, and then negotiate with the buyer, and then eventually, after a lot of doing customer service yourself, manage to sell your product. At whatever price you manage with the buyer. Now you fast forward to 2019, and then there's a lot of fast-growing marketplaces around the world that try to solve that problem by making it super easy for sellers to list their products and for buyers to buy the products, because the issue was that you find a product from eBay and then you would not be sure whether it's authentic or not. For a company like us, we provide the seller a super convenient way to sell products, and for buyers, guaranteed product and a net support there, like experience, shopping experience that you historically never got. In terms of the why we do pre-owned, it's also because if you understand the luxury industry, you look at the top of the pyramid on the most successful brands, and none of these discount products. So I went to work for Louis Vuitton post INSEAD, and then my sister and my mother and my friends called me and said, "Great, you work for Louis Vuitton?" And I was like, "Yes, I do. Can we get some discount?" And I was like, "No." And they're like, "Why can't you give us discount?" And I was like, "Because they won't give me a discount. It's impossible. 150 years of history of the brand, they don't sell products on discount." It's a very controlled world. The product sells at the price that they want. In fact, it's a whole industry of trying to maximize the price of the seller. So prices increase year on year. That's how it is. That's the world. So in that world, our top 3 brands, for example, are Louis Vuitton, Chanel, and Hermes, and you can only find them on discount at the Luxury Closet, and you can also find only like N-1 and N-2 collections on the Luxury Closet. So it's a great USP for buyers.
So maybe let's rewind back a little bit. So back in 2011, right, working post INSEAD, what inspired you to become an entrepreneur? What inspired you to think about the Luxury Closet as a venture that you really wanted to sink all of your energies into?
So I grew up in an entrepreneurial family, let's say. So my father was an entrepreneur, so I was a second generation entrepreneur. So it was very normal for me. As normal as then my family thinks it's completely acceptable to quit your job with having no business plan yet and no revenues because you want to start a company. In fact, is encouraged. So my call to my dad was like, I'm thinking of quitting, and he's like, great. What are you going to do? Start my company. Fantastic. Do you have any money? I was like, no. He's like, fine, I'll give you $10,000. Is that enough? I was like, I don't know. He's like, fine, no problem, quit. So that's, I mean, that was the, that was the encouragement that I had. Really normal to do that. On the opposite end, my perspective was, I had worked with my father, so in a very entrepreneurial setup, wanting to go work for a luxury company like Louis Vuitton, ending up there first 6 months, amazing. This is like perfection. After 6 months, being this is frustrating. So post that, the natural choice was to go back and become an entrepreneur and solve a problem which I thought that I could solve at a large scale. And that happened to be then the resale of luxury items.
And so as we saw from Philip's life, right, if we go back to 2011, the venture industry in the Middle East, relatively underdeveloped. Walk us through kind of when you first thought about raising outside money, and in particular venture capital. What was, when did you first think about this? What were some of the things that went through your mind and said, hey, I need to raise outside money in order for the luxury closet to really reach its potential?
Sure. So before I raised capital, we had some revenues. We was selling about $30,000 of sales a month. It was profitable, so $1,000, something like that. And the choices were, of course, either continue on that path and remain a privately owned company and move slowly, or compact the timeline and do everything possible to build something scalable and something more fantastic, and take this VC road, because capital allows you to do that. The second thing is that giving out ownership also gets you this amazing talent that you can't get in a privately held company. So I think those two reasons. One particular day also, we had some friends who were encouraging me, telling me they'll give me their monthly paycheck. So I think that was encouraging to know that some friends would give me. I had 3 paychecks, so I had access to 3 paychecks. So I was like, that sounds good. Maybe I should do this. So that's the route.
And then what were some of the initial conversations? So we've always talked about 3 Fs: friends, family, and fools, right? But then there's the institutional money coming in. Right? So MEVP, one of the first investors. What were some of those conversations like early on? What were they looking for? Did you feel like you had the same strategy, and were you seeing eye to eye in the early stages of the company?
Sure. So the early stage is fairly quick, and Walid is here, so it was the conversations with Walid and MEVP at that stage. They were lightning quick. It was 2 weeks of intense questioning, like I was not in a prison, but really I was being grilled for like micro details and really how are you going to do this and how are you going to do it. After 2 weeks, it was like, we're done, we're convinced. Can you come over to Beirut? And I was like, no, I need a visa. They were like, fine, I'll be there tomorrow. So Walid's partner flew, shook my hand, and had money in my bank account in like a week after. So they were, first of all, they were very, very quick. And the early stage is quick. You really have to know how to measure the right things, and it's a lot of based on the person and the idea, and where does the person can take this idea. So you really have to make the call on that. So it normally, I think, is very quick.
So you got the money, and then it was smooth sailing ever since.
Well, we raised $220,000. That was the first amount, and of course, I went to my friends and I was like, "Look, I have $200,000. This is amazing. I never have to raise capital again. This is going to build a big company," and that is completely not true at all.
So what was the first big surprise? So you've raised your first round of outside money, right? You start executing on what you think you need to do to get to the next level. What happened?
So I think the first big surprise was finding talent, right? So the first few are easy to come by because they're either really believe you or they're jobless, and then they're like, "What's my risk?" So they take the risk. But finding the talent that will solve big problems and scale the business, I think that was very, very tough. And I have spent so much of my time in that. It's a great experience because you learn while you interview. You also like, oh great, you work for Net-a-Porter, great. How do you do this? And you're like, yeah, fantastic. You learn everything from interviews. It's amazing. Mindset, they want to be there, and then everything accelerates together. If they're not the right mindset, that can lose very quickly.
Yeah, yeah. And were the VCs helpful? As you mentioned, interviewing. What are the ways in which were there in which VCs helped you as you continued on this path?
So I think the biggest help is like mindset. They're not in the business of building small businesses. So, good VCs, are able to help you on small stage and know that you somehow will make it to that, make it to scale. But they constantly reinforce that no one is in that business to be that small. And then, what is normal is double. 1 year double, then every year double. Right? So it's, I think that's very, very important. Because the minute you have have some kind of thought saying, this is good enough, they're there to reiterate this is not good enough. You can do even more. And look at these, super fast growing and amazing companies, they have done it. So that's definitely one of the most important ones. As I said, and then it depends. I think it depends upon the investor and their particular skill set. And they all help in their own ways. It's introductions, strategies, it's execution advice.
And were there situations where you felt that your viewpoint and the viewpoint of investors were at odds?
Of course it happens. It happens within the team, forget the investors or not. So I think that, of course, normally when that happens is that when you come back to sitting on opposite ends of the table, because you have to raise capital again and you have to discuss the valuation and price. So I think that is where I think my investors would say, I'm sorry, Kunal, but I'm going to the other side of the table and putting on my boxing gloves. But in 1 month, remember, it will all be over. So I think that is obviously normal. But other than, I think we've been fairly aligned on the direction of the company that has to go. It's a frustrating experience because you also want to grow faster than you're growing. I think even Kareem would be happy with their growth rates. So I think that's about it. Yeah.
And maybe walk us through a little bit how you settled on the operational model, right? So I imagine that early on there are a number of questions about what the right operational model was in terms of, even before you start scaling. How did you get to that in terms of consignment and all the ways in which you
Sure. Okay. So when so this is reminding back to very early days. So when there was the aha moment of we should sell pre-owned bags. Why pre-owned BMW, pre-owned bags, some of these bags are the price of a BMW. So yes, it makes sense. Then, we're like, actually it was just me. So I was like, okay, how do you really do this? So realize that there's retail or there is online. So I went and saw these shops in Dubai that were actually doing this business. And, at the first moment I was like, no, people are already doing it. And then on the second thought, I was like, well, they're doing it so poorly. And if they can get distraction, I can get 10 times distraction. And then second is that looking at the online businesses and then realizing that it's the future and the problems to solve cannot be solved in retail. It's just impossible to deliver to the seller and buyer what they want running retail. Online is the right option for it for various different reasons. So we're now, for example, on the site about 30,000 unique items. So just to understand 30,000 unique items, if you say every shop in Mall of Emirates has 1,000 unique items, that's 30 stores of inventory. So that in width of assortment is as large as inventory as you will see in luxury Mall of Emirates, right? This is 30 luxury branded stores. So this is quite a lot of inventory. But I don't have 30 stores. And I don't want 30 stores to exhibit this inventory. So I was like, how am I even going to show this to the customer? Normally it's like one item and then you got 10 in the back of the same, but it doesn't work. It has to be online. And then for the sellers as well, like how does the seller manage their virtual closet? If it can be done through an app, it would be fantastic. You then decide what you want to sell. You decide what to price it at. You can play with it. So both sides, it's the right adoption. Coming to consignment, decided not to do peer-to-peer, but to do consignment because we thought that was the right approach. And sellers really wanted a white glove approach. It was really, I trust you, here's my items, thank you very much, and just send me the money. So in my interaction with the clients, I thought that was the right way to serve the audience. I think that was the right answer to this stage. Now we're thinking, how do you lower all the barriers? How do you make it super simple for anybody to sell? Because sometimes people hesitate, because in the consignor model, you have to give us your item, and we will take it from you. Of course, we treat it with care. We authenticate it, we photograph it, we keep it very properly, and we deliver it to the buyer very quickly because we're warehousing the item. But sometimes people don't want to give you the item, so how do you bring those online? How do you bring businesses online? We want this to be the largest marketplace of luxury in the Middle East, and at the price point that we're at, so we're at $700 average basket, and it's the highest price point marketplace actually in the world, leaving out one or two who only do jewelry. So it's how do you serve that price point to the customer? Who wants that price point? Whose closet is that price point? I think that we're getting very good at that, and we want to serve a global audience then. Already now, 40% of our sales come outside the region, so it's US with 25%, and then UK, Hong Kong with 5 to 7% each. So it's a global business. So we're also thinking how to do this globally.
And so, were there any surprises as you started scaling up the model in terms of operations or things that you thought may work at a smaller scale?
In a Jeff Bezos interview, I heard him say, "My body's full of scars," and I think that goes with anybody who tries to scale, disruptive businesses, especially e-commerce. You have to get very good at making mistakes and recovering from them, and making sure that these mistakes don't destroy the business, and that these mistakes are obviously learning experiences. So you have to get very, very good at this, but problems can be complex, so you have to also get very good at solving complex problems. One of the complex problems we try to solve is, for example, is pricing, so item identification. So how do you, people send us 500 brands, 20 years of back catalog. If I go to a brand shop and I say, "Do you know this item?" Even they might say, "Looks like ours, but I don't know what it is." So then how do we do this, across 500 brands? So we have to get very good at that, and we have to do that in a day. And then we have to find the value of that. All of that needs to happen in a day. So that's a complex problem to solve. Forget, not at scale, but at scale it's even more complex. So you have to get used to solving all of these problems.
So let's think a little bit about what's going to happen going forward, right? So you just raised $11 million Series C. And you have a number of different options in terms of expansion going forward. Right? So you can think about partnerships, you can think about organic growth, you can think about potentially moving into new verticals. Where's the company headed?
Sure, and I think the business case is also, I think I know. The business case is also about this. So if anybody's, I think a lot of people here have gone through business cases and learning through business cases. It was actually it's amazing to do something which others can learn from. So it's amazing to be in that position. So thank you for making luxury closet an example. But before we get there, I have a joke, which is, going through business school, of course, we read hundreds of these, and they all start with, the entrepreneur. He's sitting on his executive chair, his executive office, and he always has a nice view outside the window. He's always thinking, because he has a challenge, and the response is, the frame of mind is calm and composed, and and he's confident in going to solve this problem. So then, I saw myself.
Totally accurate, right?
Totally not accurate, because I saw, this portrayal in the case, and then I was like, but it's not true. The truth is actually, a headless chicken. Where it's just like, oh my God, there's all these problems floating around, there's so many balls to juggle. So how do you do that? And then eventually, over time, you learn how to do that in a more calm and composed manner. The way we think about it is it's pretty similar to a lot of companies is geos, models, and channels. So we are born in the UAE. So how do we expand geos? And as I mentioned, that 40% of our sales are outside the region, and international players are growing like super fast, like 150% year on year. So and for now we're doing that based in the UAE. So the geo example is, of course, was a Hong Kong example. So now we have Hong Kong and we have Kuwait. So that's the two countries we decided to go into. But we decided to go into it with a very lean approach. We can maybe talk about that a bit more later. The second is models. So from consignment services, I mentioned that we wanted to move across to peer-to-peer or cash buying some items, because we know we can predict which item will sell in how much time at what price. So why don't we then put money there and accelerate the acquisition of these items so we can actually accelerate sales. And the third is channels. From being a purely online retailer, we started click and collect services, which were very successful. We then eventually opened a retail store. We actually did a how should I say, a quick way of opening a retail store. We moved out our staff, and then we said we're going to turn the same space into a retail store. It's a very nice location. You have to visit. It's in Al Barsha, the Novotel Hotel. We have a fantastic view of the Burj Al Arab, the Burj Khalifa, the Palm. Perhaps too good for us. We moved ourselves into a warehouse, and we turned that space into a really nice 3,000 square feet retail store. And now we opened the second one, a pop-up in the Marino. So in terms of channels, we're also expanding retail to serve as a channel of acquisition.
Okay, maybe kind of going back a little bit to the global expansion, right? So you talked a little bit about lean approach. Do you see kind of the same approach for all geographies, or different approaches for different geographies? How do you see that international global expansion rolling out?
Sure. So first, we see a market either as demand heavy or supply heavy. It's either of the two. We don't have any market which is equal. The US is a demand market. The UAE is a more of a supply market. Saudi is slightly more of a demand market. So the question is, do you want to first focus on demand, or do you want to first focus on supply? So I think that's a decision we make, which then pinpoints what is the kind of team that we want to put in there. So in the case of Kuwait, we said this is a supply market. So we start with a supply team. We pinpoint supply team, and the trick over there was to find a founder who works like a founder. So literally that means he comes to you and says, I want this job, you don't have to convince him. I don't want a salary. I will work from home. I have an office. I will use my car. I will. So he just accelerates very, very quickly. And the second approach in Hong Kong is that we went and acquired the operations of another company. And this for us is a demand market. So we're now starting with customer services there, focusing on buyers.
Okay. Then as you think about the global expansion, right, there's always this question of competition, right? So you started in the Middle East, right? You're the only player here, but now you're going to encounter a number of other players, some of whom are very well funded, right? So the Real is just announced their IPO this year. Like there's it's a much more crowded space when you think about global expansion. How will you deal with it?
Well, our strategy is first to focus on the supply of the Middle East. That's our mission. Our mission is to unlock the closets of the Middle East and to build a brilliant and happy experience for ourselves. So that's really what we need to do, which is super defensive. The per capita spend on luxury in the Middle East is the highest in the world. That means less people have more items, which means closets have basically more higher value. We estimated how much a closet would be worth, and the Middle East closet is the second highest average value closet in the world. So our defensibility and our strategy is to build that a marketplace of those sellers, and to build that entire process that brings Chanel bags from these closets and lists them online. So that's the first thing that we need to do, and we need to own it, and we need to be number one at it. The second, as I mentioned, is that we're very good at luxury. The top three brands are Hermes, Louis Vuitton, and Chanel. That means the sellers are the ones who own these brands, and the buyers are the ones who own these brands. So there itself, we want to focus on this customer, and if we get really, really good at focusing and serving this customer, then we can do it globally.
So one challenge, right, is that the space is, in many cases, unprofitable, right? So one of the challenges that one of your large competitors is dealing with, the real is profitability, right? So they're still in the red despite being one of the larger players. And I think that there's many who would argue that this is essentially a winner-takes-all market, right? That kind of there's benefits and economies of scale, but the only player that's ultimately going to survive is the one. Right?
So it's a winner-takes-all market by region. So in the US, so first, US is a huge market. Okay, just New York City is larger than all of Middle East. That's how big a market the United States is. So which means also in the US, the market gets split by price point. So somebody basically people serve different price points and gets served by a subsector of the luxury industry. That means that people doing sneakers only, and there's people doing bags only, and jewelry only. So a vast amount of players, and they all decide to own, one of these defensible sectors.
Although if you think, one of the things that you mentioned before was that there's some markets that are more demand heavy and others that are supply heavy, right? So if you think about it on a market by market basis, you're not matching up supply and demand.
But if you are in, so the other trick is to be in multiple markets, okay, or have the ability to sell or drive supply from multiple markets. So just to go back to the previous question, so we have now Seku in China, which is publicly listed, and they're the market leader in China. We have in Japan Komeo, another publicly listed company. We have in the US the Real, who's on the way to an IPO. We have in Western Europe the Vestiaire Collective, who just hired the ex-CEO of Lazada to head the company. So this is they're also a market leader. In Southeast Asia and Middle East, it's the winner needs to be decided. In the Middle East, it has to be us, right? In Southeast Asia, the strategy is be number one in the Middle East, own the supply in the Middle East. In Southeast Asia, it's okay to be number 2. In the US, it's okay to be number 10. It doesn't matter. And for us, the supply that we bring in, can be matched in any of these markets. And we also sell to 40 countries. So just being in the UAE, so the supply and the demand can be matched across those.
And what does this mean as you think about the global expansion in terms of your funding strategy? You approach international investors. So far, your investment base has been primarily in the Middle East. We approach international investors. What's your strategy going forward in terms of funding?
So it's now our goal to find an international investor so that aids in the expansion. Also, somebody who is in e-commerce has seen massive scale. And also, we're interested in finding a strategic investor, ideally a retailer, who helps us really expand across multiple geos. So we make our path faster to scale. So yes, we are actively looking at and talking to international investors.
And you see corporate investors, I mean, you mentioned corporate investors as one possibility. You see them also as potential competitors, and is that one of the things that?
No, I don't see them as competitors. And this is another debate because we've had conversations with corporates, and then they say, "Yeah, we'll build it ourselves." It's like invest or build debate. And then the startups really go, you want to build, you want to live my life, you want to build it, best of luck. So in that case, no corporate ever builds it. I don't know a single case of a corporate building it. In the US, yes, it's possible because Macy's will build Macy's online, same business that you are doing in retail, you take it online. But ground up innovation and scaling something is not going to happen. So I don't see them as, I very firmly believe in this, thus I do not see them as competitors at all, even if they tell me we're going to do it, because they know it's not going to happen.
Let's talk about exits. So obviously, with this investment, you have investors that have been around for years, potentially looking to get some liquidity, some LPs. what's the horizon? What's the exit horizon? Are you looking to do an exit anytime soon? Are you building your company towards a particular type of exit?
So look, in the company strategy, I mean, you can talk about, you can either say, listen, are you building value? Are you building defensibility? And that goes hand in hand with, are you building something that's exitable, right? So that is a conversation that you have regularly. But are you going to exit, or who you're going to exit to is not a conversation we have regularly now. We have these conversations with investors when they're coming on board, so they understand what is the path to exit. But you don't have these conversations on a daily basis.
Okay, so we're running on time. Just a final question. If you had to kind of give one piece of advice to an entrepreneur building a startup in the Middle East right now, today, what would that be?
So I'd say, well, two things. First, choose a large model, so in a large market. That's very important. If you find something small to do, it's just going to become small. I mean, that's what it is. That's how it works. The second thing is find all the amazing talent up front. I think that this is something that I spoke about. It's very challenging to find amazing talent. I'm very lucky now because at this stage the company has, there are some of my colleagues around here, amazing talent. I think that this is the talent that would build a $200-300 million sales company within a few years. That's the kind of talent it is. And we're lucky to have it now, but I wish I could have done it not on day one, but in year one. So my recommendation is, what you need to do better is figure out how to do that in year one.
Okay, well, thank you very much, Kunal. So stick around, we'll have a panel. We'll have Walid and Sharif coming in to join us on the panel to give a little bit more color from the investor side, but thank you very much for your thoughts. Thank you.
Entrepreneurial journey. Just to let you know, while we are preparing the chairs for the panel discussion, we actually are writing the second case study about the luxury closet and about its more digital marketing and the future of the closet. And we are discussing with another professor, David Dubois. I'm sure that INSEAD alumni know him. What is the future of our apparel industry globally? So now I'm very glad to introduce to our guest speakers. So Sharif El-Badawi from 500 Startups. Sharif, please take a seat. And Walid Mansour, who is just coming from MEVP. And we will move to the discussion about the VC ecosystem in the Middle East. And Vikas will be moderating.
Okay, great. So thank you very much, Katia. So as Katia said, we have Walid Mansour, Managing Partner of Middle East Venture Partners, Sharif El-Badawi, Partner of 500 Startups, and of course, Kunal with us. So where I wanted to start, what I've asked each of the panelists to think a little bit about is each of you has many years of experience, either running a startup or investing in startups in the Middle East. And I wanted you to just share maybe one story with the group that's typical of the state of venture capital in the Middle East right now. And just to give us a flavor of what is it like operating. So maybe what really for that kicks off.
Sure. I have many stories. I don't know even where to start. 2019 is a surprising year because the number of venture capital companies have increased, but also the number of demand from entrepreneurs has also increased, which means that you always run into interesting situations on whether it's expectations on valuations or bigger confidence in what people want to build. I guess a particular story I like is and that happened recently, is a guy who actually walked into my office and asked me if I could lend him $2.1 billion to buy back his partner's shares in a company. And I was amazed because when we started this business 10 years ago, we had a $10 million fund that we scrapped from family, friends, and ourselves, and now we're at a point where legitimately people are asking for insane amount of capital just to buy back their partners. So that's a fun story, but it's pretty much indicative of what's happening now.
I don't have that one, but I do have, I think, a particular case that we're starting to see more and more of. We knew this coming in, so I came in from the US to launch a fund for the Middle East for a US firm, 500 startups. Never lived in the region before, so everything was pretty new to me. But we knew we were going into an emerging market and things are going to be new, they're going to be nascent, people aren't going to have necessarily all the best practices in place yet. Even the government jurisdictions, regulation won't fully be there like we would expect in the US. But we've had 10 years experience investing in emerging markets, so this is an expected thing. But this year in particular, we run pretty fast as 500 startups. Our job in the ecosystem, everybody plays a different role. Our job is to kickstart at the seed stage, get a lot of investments out there, not necessarily very large checks, but just kind of seed the ecosystem and create activity. And so we invested in about 115 companies in the last 24 months. No problems there. I mean, in the beginning, we were doing them one by one, and for the most part, we were talking to these founders for months before we would make an investment, and so we're helping them with this, what we call readiness, investor readiness. And so my story really is going to hinge on this concept, where recently we started to run an accelerator in the region. We had before that what we call pre-Series A level program, but this is companies who have already been around for a year or two. They're generating $50,000 to $70,000 a month, and we ran our third one just a few months ago. But for the first time, we ran a seed accelerator program, 16-week program. Some of the companies coming into this program may not have even had revenue yet. They just have an MVP or a prototype and maybe pilots with customers. And the problem that we saw with that is that at that early stage, where they don't even necessarily have the traction yet, their corporate structuring and investor readiness in a lot of ways is not there, and nor do the founders even know what they should be doing. So probably anyone who's invested in an emerging market faces this to some degree. But it just hit us in the face with this first batch. We finished it last month, and out of the 20 or so companies that we invested in, maybe half or more than half haven't received their funding yet because their corporate structure is not there yet. And it has a lot to do with the jurisdictions that these companies have to be in for a US fund at least. And most international investors require some level of corporate structure that makes them very as an investable company. So we faced this. Our lawyers flew in from the US to spend a week with them, as we do most of our programs. We have everybody fly in for a week at a time based on the subject matter. And so our lawyers flew in, and they're just doing their one-on-one office hours with every company, and then they pinged us on Slack, and they're like, "Do you guys realize these companies, they don't even have a company?" Like things like this. And we're like, "Yeah, we know. As part of our job of kickstarting the ecosystem is to help them with this preparedness." So for us, we knew that was there, but it really is something I think we want to highlight more, and we're talking to a lot of the law firms in the region. We're talking to let's say a Hub 71, we're talking to the different hubs in Saudi and Egypt about how do you prepare founders or entrepreneurs or would-be entrepreneurs to the obstacles that they're going to have to face when they actually start a company. It's not just the commercial side of it. There are structural legal things that need to be in place beforehand. And building an ecosystem takes a lot of different stakeholders. And it starts, we say, of course, at the core of the ecosystem cycle, Philip talked about this a little bit, ends with exits, but it starts with, you have to have talent. Those talented entrepreneurs need to start companies. Investors need to invest in those companies at different stages. They need to be able to hire more people as they start to grow. And then we need corporates to play in, we need governments to play, we need everybody, institutions, because that's where the preparedness comes from. So I'm happy to say a lot of our founders are ex-INSEAD, and they tend to be the more sophisticated founders. They've just been around the block before. And the UAE founders in general as well have worked in international capacity. So they've seen what corporate environments look like. Whereas you might go into the more developing countries, they've never really carried a job like that before. So that's where we hedge our bet and try to diversify the fund a little bit, where we go for the more sophisticated founders, tend to ask for very high valuations even before they start, or that you get the 5 engineers in a garage, yet you can't even put them in front of an investor. Like, it's very hard to make them presentable. So we're stuck at this conundrum now, where we want to be able to fund anybody despite the color, size, gender, of where they come from, not go after pedigree, which is this profiling that happens in Silicon Valley quite a bit. So we want to break that mold of going after pedigree, but at the same time, you have to hedge your bet and say, okay, well, these guys, at least they're going to cross their T's and dot their I's and stuff like this. You don't have to worry from that side. So my story is more around that. It's something that we are going with these days. I think it's very relevant to a lot of founders as they get started.
I have a special one. I stole it. Okay, so I think I'll go back and maybe speak a bit more about the size. When we first went out, let's say talk about maybe a round before, and we were going to investors and saying our business plan was saying that we'll build a sub $100 million sales company. And then the reason we did that is because we were like, no, if you say you build $150 million of sales company, is too big for the investors. They were not going to believe you, so you should not show it. So we had to keep it down below $100 million. I think that is completely not true anymore. I think that it's the opposite way around. When you go and take a small business plan like that to investors, they're going to ask you to, they're going to tell you that your ambition is too small. So it's a different world.
Would you agree with that?
Well, I mean, it's a testimonial of the size of the market. Over the past years, it actually grew. It's driven by, when you talk about consumer internet and SaaS businesses, it's driven by digitization primarily. So that's basically most of the activity that you see. In the case of Kunal, because we go way back into the funding of the luxury closet as a case study, it is particularly true because every time you look at the numbers and run them, if you're sitting in the beginning of the journey, seeing that you need to build a $100 million business, whereby real back then hasn't even hit the 500 million, you're like, okay, maybe that's not going to happen in the coming 2 to 3 years. But then today, you grow beyond the real copy-paste story because that was important to start. Now you're looking at, okay, there's a huge market, it's going online, how do I capture it, how actually leapfrog the growth that a real or a Vestiaire or a competitive clone might see. So it's definitely a change of addressable market sizing. It's driven by many things because when you talk about the MENA region, we talk about the Arab world specifically, to be clear on the definition of MENA. The Arab world in many aspects is extremely mature. Like when you talk about infrastructure, telecom, banking, etc., has been around for, this is not an emerging market. I mean, at least the GCC part of it. So what has happened recently is that the online component of it has kicked off, whereby in China and India leapfrog because you needed to jump over infrastructure. Here so I agree with that. Now when we're at the board meeting with Kunal, we're looking at conquering other markets, and that journey is what took us 5 years to get here. It doesn't seem like 5 years; it seems like 50. But yeah, now it's actually exciting to be able to do that, and that we have the capital to do it. So, and it goes back to the idea, and that's why that Kunal was talking about. It's just as an entrepreneur, as a founder. I'm a founder of the largest VC in MENA, so I really relate to that entrepreneurial journey. So at the end of the day, is the people you do it with. If there's no commitment, if you're not looking eye to eye, if there's no heart and there's no vision and there's no passion in your story, then no one will believe you, no one will follow you, no one will write you big checks. So that's extremely important, and that's becoming also another component of what we do in scaling up those companies, because now we're leaving the phase of okay, let's get inspired by all these models outside and see what works and try to copy it. Now we're like, right on, just tell me about your story. What do you want to do? Who are you? Where are you from? What's your history? And why are you using the internet or the software to do what? That's exactly the kind of stories that we see today. So to go back to the story about that gentleman who walked into my office and asked for $2.1 billion, that was not it. There was a legitimate request by an online business that's probably worth more than that. That's fantastic to be able to witness it and see it scale.
So I want to push on this point a little bit, because this was something that Philip showed us in the slides, which is if we look at the total amount of funding over the past 5 years, it's from about 10x, number of deals about 5x, and so the really question for Walid and Sharif is, what does that mean for you guys in terms of deal flow, right? So as you sort of see increasing interest in the space, lots of players moving in, are you seeing higher quality deal flow? Do you have to work harder to get great deals like Luxury Closet now than you did several years ago? How is deal flow?
Yeah, see around 1,000 companies here, we invest 4 to 5. This is just us. And something I learned is that recently with time, I'm less and less interested in the number of the deals or the business plans. I'm really interested in people. This is a people's business. So whether I'm able to, work with them, whether there's chemistry or not. And reflecting back, we've probably invested in more than 50 companies since we started. Thank you. Most of the failing companies we had, most of them were actually due to a dislocation between the entrepreneur and the environment, whether it's the investors or even the market. They were not driven by competition. You had a point on competition before. Competition for me is not something I take into consideration because especially in software industry, competition is not important. Software has always been built up doing a better job than your competitor. So we dismiss competition as a threat, but we look at it as how can we learn, how can we do better. So most of the deal flow. So on the question of deal flow, what I look for now today is really the story and the person behind the story, whether I could actually contribute and work with them and build that relationship. Like in year 2 and year 3 to come sit down there and say, okay, look, we built this, where do we go around? This direction or this direction? That's extremely important in VC, and that's not very different from VC in any other part of the world.
And has that changed? I mean, one of the things that Sharif highlighted was readiness, right? That kind of how sophisticated are the entrepreneurs that you're seeing, and if you look at the quality of deals.
The average age of the entrepreneur we invest in happens to be 38 years old. So, and that's been always consistent with us. So, because at the end of the day, you want to invest with the people you think are going to make it, and out of the 1,000 deals you see, a lot of those are just not ready. So I don't feel that we're readier today than before. I think the equation is show capital, and then the good people will be attracted like a magnet.
Yeah. So maybe let me
to capital.
Let me put this trend to Sharif, because I think the 500 model is a little bit different, right? At least from what I understand in other markets, more of kind of seeing all the deals in the market and kind of smaller ticket size, many more investments.
That's right. It's part of our fund model. So and it's quite different. So we play in the seed stage primarily, first checks, and then we do follow on into maybe one more round after that, and about 25% of the fund. So half the dollars go into the next that second check of 25% of the fund. We've done this across 19 funds globally, and we've seen the model work now, where our vintage 2010, one of our first funds, is now performing in the top quartile of all VCs. So we think the model works well and has a mission behind it because you're able to kickstart and invest what we call early and often. It's a very different model than a boutique traditional VC, which might have a small team of partners, doesn't do a lot of operational stuff beyond the investing. I'm jealous of that sometimes because it's a headache to do the other way. And we get one advantage, which is we have a massive brand, right, globally, and that brand attracts people and founders. Second, we run programs, and we open applications online, and we attract more deal flow. So when I'm fundraising and I have the pitch deck slide of how you're going to get deal flow, which every VC has to show how they're going to get deal flow, we got that one. But that's a problem for us at the same time because it's so noisy. So we see maybe 2,500 deals a year. We invest in 60. So it's a similar. It's a Stanford Harvard acceptance rate like ratio, but we are known in the market as spray and pray. So take offense to that, but because we do have a rubric internally after 10 years of being a 150 people company that we just do it at scale. So we do a similar level of stringency of the sort of evaluation, but we just are trained to do it this way at scale. And I think my challenge, or what I've found in the last couple of years as a challenge, is I need to build a skill where I can look through that noise and still be able to spot that quiet founding team that's sitting there, not going to the big events, not speaking at things, and somehow be able to spot them. So I need to network, I need to be proactive in looking for them. Working with co-investors, working with entrepreneurs who refer them, those are like usually where we find the nuggets. It's not the thousands that are just chasing at us. And so getting through that noise is hard because you want every founder to even get a fast no and to get a respectful experience or to have a good experience anyway, even though you're going to say no. And that's difficult to handle that kind of volume. So referrals, warm referrals are always the best way to get our attention. And as we grow our team, we're going to start to have associates that are going to be doing the screening, not the GPs of the fund. I think that's an appropriate level of sort of match to those founders that are less experienced, because the more experienced founders will get a warm intro or know somebody in the network who can talk to us directly. But that's how we'll probably deal with that problem.
So you talk about the global brand and then kind of the movement into MENA. What I'm wondering is, how different is the model in the Middle East, if at all, from what 500 does in other locations in the US and Southeast Asia? Are there things that you have to modify for peculiarities?
We are very true to the model in MENA. And the model is 50% first checks, 50% follow-ons of the dollars, $100,000 average first check, and go up to $500,000 on a second check. Our funds build a little bit of the sort of risk mitigation of this model into the fund structure, rather than negotiating very hard with founders, because we want to be very founder friendly, very fast on our deals. And so we don't squeeze them to death when we're negotiating an investment. We have a standard KISS stop. It's used globally. We have adapted them to the markets here. So we're very true to the model that way. On the flip side of it, 500 startups, 50% of us is the VC fund. The other 50% of the company are ecosystem building and training and education programs that we run. So we run them with you guys, we run them with Stanford, with Berkeley, on the education side, and then we run accelerators, one of the top 2 accelerators in the world, YC and 500. We're used to doing that operational side of the house. It's not where I sit, but our company does. And in MENA, we have adopted the same thing. So we run the pre-series A program once a year. We run a seed program now. It's going to be every 6 months, twice a year. And it's because it also is part of hedging the bet for these very early, unripened founders. And I'll put a check there, but I'll put a check there if there's 16 weeks of training paired with my check. So that we don't have to slow down on investing, because our model is to invest early and often and sort of kickstart. Now, that said, we are now about to go into, I probably can't say this publicly, the next one that we have, funds, let's say it this way, VCs have to raise a fund every 2 to 3 years. So we're already 2 years in. It's going to get to that next part. And then this next one is going to be bigger, but we're probably not going to change the model much, but we may move up in the dollar amounts because the ecosystem is maturing drastically. There are tons of new entrants of venture capitalists or investors in the market, as Philip outlined. That's going to create a lot of noise. It's similar to the noise we all created in the last 3 years for Walid, when he was like the only guy in the block. So it's good and bad. Like
you don't think about competitors.
No, I want more. more. I mean, I think we still are lacking investors at every stage in every sector in every market in MENA. It's just you need them to have the right focus and specifics. Now, most of the new VCs are coming in are brand new to investing, so that'll have its challenges that come with it. But I'm hoping now we're going to take a step to somewhere hybrid, like not the old V500 model and not the boutique model, but somewhere in the middle. So we won't increase our fund just because the fund size is increasing. We're not going to increase the portfolio size, and we will go to 200K average checks in the beginning, and then we may lead our Series A's. So a lot of the bigger VC funds are multi-stage VC funds. They follow their companies along. Once you're with them, they'll stick with you as long as they're performing and stuff. And so I think we have a somewhat of a duty, I feel like, to also do that, because we invested in 115 companies at seed. However, 90-something of them can't find another investor. And so part of it is the readiness. They didn't do well with the first check we gave them, or wasn't even enough in the first place. Founders tend to raise whatever they can get their hands on rather than raise per plan. And you have to raise to a 12 to 18 month period so that you can hit this awesome milestone where that next level VC says, this is exciting. Here, and we don't blame them, this is just the beginning of the ecosystem, right? But they tend to take 50K because they can take 50K. A month later, they're out fundraising again. Well, that doesn't signal very well to the market. What'd you do with the first 50K? Well, almost did this, but I didn't quite get there. So that's not great. So I think our evolution will go in that direction. We'll still kind of have the core model, but we will sort of move up the ladder a little bit, which is very common in more mature VC markets.
So a question actually for all three of you. So one of the things that we talk a lot about in entrepreneurship is the so-called valley of death, right? Does that mean that basically between concept, starting the company, and then raising, say, Series A or early rounds, there's a lot of companies that simply fall off, right? That are unable to continue raising. If you think about kind of, particularly in the Middle East, what would you say is one of the highest impact lever that VCs can pull to help entrepreneurs through this valley of death? And it'd be good to hear from both you guys as well as Kunal, like from
Yeah, exactly. So predominantly MEVP is today, although we started as a seed Series A, predominantly all we do is growth now. So we write checks we can write $100,000 check, but we write much bigger checks now. And actually we lead much bigger rounds because we bring a lot of co-investors with us. We raised over 10 years around $300 million. That's our funds, but We raised 100 million co-investments. So to your point, yes, the market needs growth tech. So this is where we play, and this is where we differentiate. And go back to the value of that. There's values of death at every point.
Yeah, they're everywhere.
It's like a big, it's a canyon of death. It's a Grand Canyon. So, but it's the same for us because we also raise funds and we keep on raising. So I think capital, people underestimate capital. It's funny because now when you talk about capital, people forget, a few years ago, nobody had money. Right? Because now people walk in and talk about millions of dollars as if it was, paper monopoly money. It's just, money makes companies. So money is important to everything. There's no money, there's no entrepreneur, there's no business, or there's an entrepreneur with no business. So the capital, solving for capital is in a market that does not have an IPO route, or does not have a thriving software economy, or doesn't have necessarily the market, or has very fragmented. Solving for capital at scale in this market is, I think it's a very important added value to everything. And if you want to be a multimillionaire today, if you have any ambition of being rich or exiting, or the only way to do it is to build a business. And you can't build a business just by your own savings or your family savings. You have to go and seek external capital and private capital and scale up capital. That's the only way for you to walk out someday with an insane amount of money and you retire on your island. That's the only way. So capital and what it means and how to raise for it and how to deploy it and how to have a relationship with the investors and the whole supply chain of capital that is basically starts with small checks and then ends up with exits. That supply chain is what we've built here, and that's very valuable. And people underestimate, a lot of entrepreneurs, and people take that for granted. They think, yeah, there's a lot of funds, a lot of VCs, no, that doesn't, that's one. Second, going after the wrong investor, wrong VC, just because they're new kids on the block and they need to show portfolio to their investors and they're willing to write any amount and any check. That you're not, giving yourself anything. That's one. Two, experience matters, right? This is the software internet industry what we really focus on. We're not sending people to Mars. I don't know how to send people to Mars. I know a little bit about the internet and software business and about the online business. So if you're interested in my experience, I'd love to share it with you. Under the umbrella of an investment and a journey together. And that's, people also forget that. A lot of entrepreneurs walk in the door thinking, I know it all. No, you don't know it all. You actually have to recruit a lot of people who are smarter than you to do what you need to do. Your role is to, be the captain, the cheerleader, but also you have to go to investors, whether it's Startup 500, who's a reputable brand, global brand, or even if it's SoftBank, right? Or anyone in the middle. And prove that you have the knowledge and that you can actually learn and interact and that relationship building with the entrepreneur and that experience is important to cross these valleys of death, because what are you gonna? So you're raising from C to A. What's the story, right? So what's your deal? Tell me, what are you building? How's your product? Are you scaling? How are you gonna? Where's that? What did you learn? B2C. What did you learn? That's different. Pre-IPO. We're working on a pre-IPO case today. This is the first time we do it. It took us 10 years to come to a point where we're actually building on a pre-IPO, and we're learning, right? And then the entrepreneurs are learning, and all together are learning, and we're actually gonna go raise money on global markets to this and one of those, and that is very important to go with the cycle of learning who to choose and so capital, experience matters, and the third, look, this is very personal. This is my journey, my own story. If you don't have, there's no heart in anything you do in that. Don't do it. Honestly, there's so many different stories out there. What makes you unique, in my opinion, is how much heart you have in that story, and that builds a better product, a better brand, that attracts better capital, better people. And that's a very hard, difficult thing to pull off. So the third dimension of crossing those valleys of death. It just does your story have any heart? I mean, is there anything exciting, anything interesting, any passion into what you're doing, anything really different? You know that. So I think the greatest companies that were built over the past 10 years in the Middle East, and we can dissect a lot of them, have consistently an amazing culture, an amazing brand, and an amazing team that have put a lot of heart into building those companies.
So Kunal, your thoughts on kind of the valley of death, how can VCs help? What's kind of the one biggest lever that you pull help entrepreneurs?
So look, what resonates with me is like this is true that you raise capital and then you run from there into exhibiting metrics 12 months down the line that you're able to raise on, and then 18 months down that line you've raised more capital, right? So this is how it really works. And as I mentioned, there's a lot of mistakes you could make where there's misfires, and 12 months down the line you don't end up where you think you'll end up. It happens quite a lot. It happens almost every time that you misplanned something. You get, of course, better at doing this. One of the things that I when I was there at the 500 Startups office is that yes, they specialize in making sure that those misses get reduced by their experience. So I had a session with somebody who does growth acceleration, or I think there's one person just like who dedicated to look. Here's all the internet businesses you could run. Here's for every single internet business, the 5 most common problems, and here's how to get plug-and-play solutions to these problems. Do not invent this yourself. They really had a 1-page PowerPoint, and then I tried to solve so many of those problems by myself, which was stupid. I don't need to solve those problems. If somebody just said, here, this is really common, here's how you solve them, or just go to these guys, it would just, saved me so much pain. So, so choosing what to execute, having the capacity to execute this, putting your capital and time there. You have to make all of these choices, and if you make wrong choices, then you're not going to get to the results. So, as I said, with experience, you get better and better at making those choices. The biggest choice, of course, here is people. You choose and they choose, so it works together. And my biggest mistakes have been not being able to find the right team member there, and that's what has in that particular instance of problem has derailed me the most. But there's so many of these.
So what do you look for?
So it depends. So of course it's if you have skill, if you have expertise in what you're looking for, and you have a culture match, and you're very hungry, that's a fantastic combination. Now that happens very rarely that you get all of that, right? So I think then if you don't get expertise, then it's great to find the person with the right skill. I think hunger and the hunger to build is the most important of the lot. That's just the most important. Culture fit is the next most important, which is that the person has to really be able to come in and make the most of what is around them, and the whole company accelerates because of you. The whole company becomes better because of you. And then comes skill, and then comes experience. Experience comes the last. But it depends. I mean, sometimes experience is very important, but you never compromise on the first few things for experience.
So one of the things I wanted to turn a little bit to is the sophistication of entrepreneurs. Have the views of entrepreneurs about venture capital changed in your experiences over the past 5 or 10 years or so in terms of what benefits venture capital brings, right? Thinking about VCs more than just sources of capital. How is that?
I hate that question. No, I hate that question because it's an unfair question, because at the end of the day we're both into this together, right? So if we're not looking eye to eye, there's no chemistry, there's no passion, there's no vision, there's no skill set, there's no, I mean, we're gonna, you know, so whether the entrepreneurs use VCs, and I feel as a VC we always have to go and, you know, justify ourselves. Most of the time we say no for a reason, you know, that's an unfair way of looking at it. I think they grow, we grow together better. Definitely sophistication for me has always been there. It's not like all of a sudden people got smarter or more. It's just I go back to that. When you solve for capital, the experienced smart people who work in institution, who feel stuck in their jobs with no ambitions, and then they get the ceiling is too low for them, have an alternative to go into a bigger space and build something far more exciting. When you solve for capital, people come. You'll see the talent. The talent is all over this room. Sounds like a commercial, but it's not. That's what you basic human, you know. So whether you're an expert in machine learning or an expert in big data, and you know how to parse the data lakes or parse data, but okay, fair. I give you that some regions are better than others, but you learn, right? And again, we're not sending people to Mars. This is the software industry that is a combination of an amazing product for a certain market at a certain cost structure, you know, and that has to, there's a lot of innovation in it, but it's not completely out of this world. People can do it, people build it, and people can beat an Uber or an Amazon at their own game. That's proven, and I think there's no doubt about that. So to go back to your question, we've always preached. I mean, we started investing and looking at entrepreneurship 13 years ago, before MEVP. And Dubai, I mean, because we were headquartered in Dubai, based in Dubai. In Dubai, 2006, UAE was a completely different country. And the biggest problem back then was SME funding. It's just today we call it startups, right? But still it's the same, small, medium enterprise and trying to. What has happened since is that the tech-enabled revolution has enabled a lot of these businesses to do well, but the premise is the same. A lot of highly talented, trained people with experience with education that did not have access to capital. Once you solve for that, you solve for half of the equation, the other half is just execution. I'm actually pretty excited about the future. I think this room is full of people. That wasn't the case when we started. We were much smaller groups. We used to feel lonely and cold, and now it's big and warm, and that's testimonial of, and also the VC community, the group. I think a lot of VCs, a lot of my colleagues around, especially the new ones, are going to fail. Statistically speaking, that's the reality. It's not. I'm not saying we're going to succeed. I'm just saying statistically speaking, you cannot have 150 VC. The same thing happened, by the way, in 2006. It was called private equity, right? So when you were looking after the PE industry in Dubai back then, you had around 120 PE shops. And after 2008, only 3 or 4 survived. The Abraj and the Gulf Capital, and those who actually survived that value. The same thing will happen in our industry, for sure. The reason there's money today has to do with the fact that there's a stimulus package put into the economy. There's more appetite from investors to be in that economy. They see a business opportunity. Interest rates in the US do help, because if you have money today, where are you going to park it, right? So
do you think LPs get that?
Yeah. I mean,
so they're on board with that.
When you analyze the VC community, how it's, I think the ones who are going to survive are the ones who can raise, deploy, identify the great companies, build the great companies, because they don't get built on their own, they get built with capital and help and strategic and present connection, and exit. That's 5 different jobs. this is how it's gonna look like. That's my 2 cents.
If you wanna,
I know we're at time, but I'll just cap on that because I think that's an excellent point. That founders, look, they're not gonna be that discerning yet in this market about VC or not VC. They're like, capital's there, I'm gonna go try to pitch for it. I think we on the other hand are looking at these businesses. Are these venture tech scalable businesses? Because those are the ones that warrant venture capital, just by the whole definition of how it is. Otherwise, they're lifestyle businesses that want venture capital, and so we're weeding out a lot of companies just based on that. But I think the statistic in the US is something like 75% of venture capital funds fail. They don't return 1x, which means they don't even return the money back. So that's definitely going to happen everywhere else. We know that the odds are against us in the emerging markets. But there are a lot of other pros, and I'm also very excited about the future. We happen to have very different type of makeup of LPs, the folks that invest in our funds here than we do traditionally in the US. Here there's now sovereign wealth funds with fund of funds that are created so that they can stimulate, because there is a drop in oil prices, and so traditional ways of building GDP are not going to be there in the future as much. Jobs and other things are stimulating developing countries. There's impact funds investing in North Africa and Levant. So the LP set is quite different, but LPs to me are a lagging indicator to our industry. So we can't wait and say, what are they going to be doing, and then go invest in startups. Like, we have to continue to do it. Hopefully we get support from folks like them, or otherwise we'll scrape along like a lot of us have to scrape from just whoever we believe. And then one day I think capital will wake up from other markets, like usually, like Philip said, coming from Asia faster than coming from the US right now is what we see here.
so we've got about 15 minutes for questions.
Yes, absolutely. So are there any questions on the floor? Yes.
Hi, my name is Munish, and thank you guys for coming out. This question is for the panel. With regards to founders who have a specific domain expertise and are entering the tech world but don't have the tech expertise, what kind of viewpoint do you have or advice? Should the founder get into it, or should they look for the co-founder who has that tech expertise, or whatsoever?
Find a co-founder.
100% find a tech co-founder.
Yeah, because you have to talk to somebody who knows what they're talking about. So that's important. And second, you're gonna build a product. Somebody's gonna build something to show to others. Somebody's gonna build it. Doesn't have to be just one person. It could be just a team, right? And
If you're outsourcing it, it's
no. I mean, look, we've had cases. We've invested in a company, actually a huge company now called Shadwell, which was born in the UAE. Became a global leader of SaaS software service for the beauty industry. Has amazing traction. They started on an outsourcing model because they needed to show something, but what they ended up doing is, and what we helped them do as well, is just reverse merger and buy the team, just fund that acquisition. Eventually you can scale a business if your core tech is not in-house, but if you're hacking your way in the beginning to kind of show something and it works, then why not? I mean, this is a situation where the end justifies the means, because the end here is to show product market fit, not necessarily that you're the smartest tech person in the room. That can be built up. If there's product market fit, then you can also, then you pass the first kind of test to raise capital.
Any other questions?
Well, I'll give another tangible reason for that is that if you are just a business co-founder or co-founding team, you have to have some way to spend on building your tech, even if it's an outsourced team or an in-house team. But if you have a co-founder that can code, or one of the founding members can code, you can be ramen profitable and build this company without any investment for a long time. So the bootstrapping is a lot easier to do. And I'm a non-coding founder in over a 12-year period. 5 of my companies, I had technical co-founders. For the ones that I didn't, it was the biggest frustration is that I have to go find a good team that will develop it. and then I have to pay them, so I'm constantly pouring out cash every time. And it's very different than if my buddy who's on the company with me can code. I'll go out and I'll do the other things. I'll go do fundraising, I'll build the business model, I'll write the specs, and the other person's coding. So like when you do that, it's a lot easier to get off the ground. And we have had some of our companies go pitch to YC and go pitch to other firms. First thing they said is, once you have a technical co-founder, come back. So there's now a criteria, there's a bar there, because they know this over the last 30 years. It is a lot harder if you don't have a technical co-founder. So these are tech startups, right?
So I started out with actually outsourcing this, but the version 1 I built it myself. So I knew enough to build version 1, and then from version 1 to like 1.1 until we came to 2 outsourced to a different place, and then version 2 outsourced to version 3 outsourced to a different, more elaborate setup, until we're like, it's never going to work, bad idea. You need really geniuses to take us further.
Good evening. My name is Konstantin, INSEAD 16J. My question is perhaps more to Sharif, because you have a younger portfolio of companies. From your experience, from the sample of startups you invested in, could you highlight the key things, key differences between those companies who were bootstrapping for a long time versus those who came for professional money early on? And also, second thing, what would you advise to those who still have chance, let's say, who have choice, either bootstrapping for longer or go straight away to VC? What would be your criteria to choose?
Sure. So I'm a little torn on this. I mean, I was brought up through a culture in California where you bootstrap until you prove something, and then you can ask for money. So for me, it was very hard for me to raise money until I would put money in me, right? So and so my own bar was high, and a lot of my friends were the same way. Like, you got to show something. I had to make all my sales first, and then say, okay, maybe I should raise money. The culture these days, maybe it's a younger generation than me, but the first thing they think is, I can't do any of this unless I raise money. And once we hear that, it's a big turnoff. Like, if you haven't even tried friends and family, you haven't even tried bootstrapping, have you guys even stayed up all night to do some work? Like, so we kind of question sort of the commitment level, or is this just a trendy game that they're doing that, like, we thought of an idea last night, so today we're raising money. Like, that's a shortcut mentality, I think, for us. Now, the catch to that is the more sophisticated founders, the ones who, I worked at P&G for 5 years, and I worked at Kareem for 10, and now, or for a few years, and then, so we're coming to you right away because we know we're going to be big. And so we get that too sometimes, and we don't want to dismiss those guys, that team, the same way we would as somebody who's just being lazy, because chances are, and I've seen this already play out, where we say, look, you're asking for a 10 million pre-money valuation, you haven't even launched yet. You guys, 3 of you are on $300,000 salaries. You've never bootstrapped. Like, you don't even know what it's like to struggle. So it's a no from me for now. Build something and come back. They don't come back. Somehow I read in the paper they just raised $5 million the next day. Like, what the heck? Like, who is believing in them, right? And that doesn't necessarily mean they're bad. They could succeed. So what we see, like, I was comparing Egyptian founders to Dubai founders. Dubai founders, a lot of times the ones we at least we've seen get approached by, they have this sort of very high life mentality. Valuations and burn rates. So burn rates is something we pay attention to. We had a company, $100,000 burn rate, and they have not launched yet. What are they spending all this money on? Oh, it's expensive to live in Dubai and maintain my penthouse and my BMW. I'm like, oh, well, I'm sorry. I lived in my car for 6 years doing my startup, literally. But so, how I can't get myself to fund a company like that. There's a very good chance that those guys are going to convince some dumb money. We don't mean that in a derogatory way. It's just not what we call sophisticated investors. Not that I am, but sophisticated investors in general. So they will raise from some uncle, some dude that their cousin at McKinsey says, "I'll put $500,000 down," or have a friend in Saudi put another $1 million. They got to the $5 million raise. You don't recognize any of the names they raised from, but they did it at that 10 million valuation or something. So for me, it's a bit frustrating, and I'm torn. Maybe I'm in the wrong here, and those guys are in the right, because I'm still sitting here as a poor VC, and they're becoming these rich founders, it seems like. Who knows? But it's just not my moral, where I like to sit. It's not my cup of tea.
So just follow up on that. How much of that do you think is just due to a huge amount of dry powder, right? And kind of lots of money out there in venture, so you just have a lot of these founders getting funded based on, right?
A lot of it has to do with the fact that there's a lot of money being put into the early stage, and there's a lot of excitement, and there's no proper filtering. That's why 99% of that will end up in tears. We've seen this many times before, so those cycles are not new. Speaking of Egypt, before the revolution, and other countries around the region, it ends up in tears.
Yeah. Hi, I'm Anuj. I work in a bank. So my question is more from Kunal. So you mentioned about passion for the idea and the startup you are building. So were there moments of doubt? Does it happen that though you are convinced about it, but at times there are doubts because of various reasons, because of market, because of competition, or other things?
Oh yeah, you're always full of doubts. Yeah, but this is the same thing. It's like courage is not you do something in the absence of fear. Courage is when you do things and you're very scared, but it just makes sense to do it. Then you do it. So of course,
See, this is hard talking.
Yeah, this is real. It's real, man. So look, I've given you a politically correct version. The unpolitically correct version is I emptied my bank account to put it into the company. Of course, people looked at me and they were like, "You guys crazy." My parents, like I said, I had a lot of support from my family. But literally, when I started the company, and then I had $4,000 left in my bank account, and then I was like, now's the time to marry my wife because I have $4,000 and I can buy her a ring. Because next month I won't even have the $4,000 and I cannot marry her. So I immediately ran to to all the money, zero, and I bought her a ring for $3,500. And then I had $500 to eat or take her out for dinner and propose to her. So that's what it was. Now you're asking me, was I doubtful? Was I sure?